Dear investor, in this edition, let us focus on risks. Risk of oil prices flaring up, risk of higher US bond yield sustaining for longer, risk of currency depreciation, continued FBII selling, and uncertainty around elections. We will also see how our portfolios are positioned for these risks. And of course, valuations and flows. So on sustained higher oil prices, this is a risk which has emerged on account of war of Israel and Hamas. Following factors need to be considered. There has been no immediate impact on current global oil production, but the risk is that supply could be disrupted if there are restrictions imposed on Iranian oil exports or if disruptions spread to, let's say, Strait of Hormuz. However, we have to understand Iran as such has not been implicated by anyone, and there seems to be no direct evidence of the same in the attack Hamas did on Israel. Next, Iranian oil flows have risen actually from 2.58 million barrels per day in December to 3 million barrels per day on China's effort, and most of the international production goes to China and should be stable. US and Venezuela have reportedly progressed in talks, and talks that would ease US sanctions by allowing at least one additional foreign oil firm to take Venezuelan crude for debt repayment. If successful, this will help boost Venezuelan production by around 200,000 barrels per day within 4 to 6 months, from 0.8 million barrels per day to around 1 million barrels per day in the first quarter of 24. Saudis are the biggest swing factor in oil, and they have signaled that they would be willing to boost oil production early next year if crude prices are high. Given the above factors, we believe that since the oil markets are balanced, the spike in prices reflect the risk premium that the current uncertainty warrants, and over the next 12 months, oil should trade around $80 billion, except for brief spikes on account of risk enhancement as the one that we are witnessing just now. Now, Indian economy seems to be well positioned to withstand oil prices at around $80 per barrel and also withstand spikes of short duration. The table below shows that the trend of current account deficits over the year and our projections for financial 24, it shows that at an average cost of $87 per barrel of oil, our current account deficit would be lower than the capital account surplus, and that we would still accrue forex. The net balance is reached at between $105 to $110 price range for oil. In FY25, as India gets included in JPM bond indices, it will receive around $25 billion of incremental FPI flows, which should largely prove to be stable. This would further strengthen the reserves. Forex reserves are our insurance against external volatility, and also gives us ability to withstand higher oil prices. Given the relatively good outlook on current account deficit and forex, we believe that the growth impetus in the economy would not be dampened till oil crosses 100 per barrel. Now, how to hedge against this spike in oil prices? Well, India offers very few real hedges against spike in oil prices. Taxation increases cap the profits of oil producers. Oil refining and marketing companies see retail pricing in a manner that protects their overall profits over a period of time and don't allow them to make any supernormal profits. That's been the experience in the past. Other energy sources like coal see stronger demand, but here again prices are regulated and volumes are the key driver of profit. But yeah, what higher prices of crude could do is to keep the policy focus on renewable energy. and the resolve to indigenize other large imports. That should get stronger. We believe renewables and EMS exposure in our portfolios hence to continue to experience policy tailwinds. We have a good exposure to manufacturing in the portfolios, and higher energy prices should be expected to dampen margins here. However, we have to understand with products priced on import parity, okay, and our sourcing of cheaper oil from Russia and other sources, it is giving this country a $5 to $10 benefit, which is divided between oil refining companies, government, and Indian manufacturing. What comes to Indian manufacturing is showing up in some manner in the higher margins. Being exposed to export-oriented sectors like IT services has typically proved to be a good hedge, but this space suffers from headwind from the next risk factor, and our house is less exposed to IT. So the next risk factor is of higher US yields and the NPA pains for US banks. Now, US is the largest economy of the world, and after keeping rates close to zero for a long while, it is seeing a spike in bond yields. The 10-year bond yields are now close to 5%, and practically all issued US bonds are at a loss. For the bond holders, we saw 3 US banks collapsing when the bond yields crossed 3.5% mark, and now we are close to 5%. Many banks would have, on a mark-to-market basis, very small net worth left. However, banks need not recognize losses on held-to-maturity paper unless that paper is sold, and are having income support from better lending rates. Deposit rates continue to be low, while let's say lending rates are or have risen along with increase in 10-year bond yields. Over time, hence, the impact of treasury losses can be taken care of through higher NIMs in regular business. The other risk in the US is the stalling of real estate market, where borrowers could see loan rates spike up over a period of time, and now new houses are selling for lower prices versus older, and owners may have to put in house equity rather than take out house equity, which was the case for several years in the US. This raises the concern on bad loan spike from a sector considered safe, and also other sectors for similar reasons. Overall, banks there are pointing to lower margins versus earlier, and most of the bank stocks in the US are not doing well. There is a possibility of more banks collapsing as we go forward, as Fed tightens further over a period of time. However, this time around, there is a key difference versus the 2008 collapse of Lehman Brothers. Lehman had a lot of OTC derivative contract, and its collapse suddenly led to a counterparty risk, and the markets froze. This risk is much lesser today. Collapse of 3 banks in the past happened without creating market ripples. If the counterparty is the exchange, this risk gets taken care of to a large extent. Higher US yields lead to a flight of capital back to the US. Indian corporates would find rollovers of debt more difficult in the next year, and we as a country could see forex outflows. Along with inflation impetus from higher oil prices would constrain our own regulator RBI's ability to lower domestic rates, and we should be prepared as a country for higher yields sustaining for longer. Here again, our forex levels provide a level of comfort against volatility in Western geographies, against washing upon Indian shores. How are we positioned for this risk? BFSI is a large exposure for Indian IT, and hence we believe that slower growth of Indian IT could continue. while order bookings are strong as clients go slow on execution. As a house, we are underweighted IT and exporters and are more focused on domestic themes. The mid-cap IT companies that we are exposed to have a relatively lower, if any, exposure to BFSI. Sustained higher bond yields may lower the pressure on NIMs on Indian banks. We are invested into high AUM growth banks. High AUM growth would be the key driver for profit growth in the next period. Coming down to the next risk of sharp currency depreciation. Well, INR is trading at the lowest level versus the USD. However, it has been relatively more stable than its own past and is relatively performing better versus peer group currencies. Improving prospects on current account deficit and inclusion in JPM bond index are tailwinds that India has versus other countries, and it should help currency stability as we go forward, relative stability as we go forward. However, if the forex reserves have a sharp fall for any reason, we expect RBI to focus on shoring up the reserves, which higher reserves gives it credibility and makes INR more stable than otherwise rather than defend the currency. A depreciation in a currency actually provides some margin tailwinds to India Inc. In the past, market used to react negatively to a currency depreciation because the FBIs pull money out in anticipation to save against forex related losses. However, now since domestic flows are the dominant flows in the market, this risk is much lower. Like most markets who react positively in a smaller currency depreciation, we expect the same to be seen in the Indian market as we go forward. Risk 4 is FPI selling in equities. We believe that at current high bond yields in the West, it does not make sense for an international investor to invest into emerging market funds. India has seen some FPI flows. We believe it is mostly on account of substitution effect, taking out money from other emerging markets in favor of India, while overall EMs may have seen outflows. Now, this situation can continue. FPI's hold is more of larger caps, and hence selling is seen more in the larger caps. Sectors which are large and liquid such as banks and IT may be seeing more of selling. However, to note here, global investment banks such as CLSA and Morgan Stanley have been advising clients to bump up India exposure, and this may help keep selling pressure lower than otherwise. Now, how are our portfolios positioned for this risk? Like we have shared before, story of domestic market is that of domestic investors coming into the market structurally. Formalization of the economy and improving per capita is resulting in investable surpluses. SIPs are now a larger part of net inflows into the market, and half of the money seems to be going to the mid and small cap funds, providing this part of the market with a strength that was not seen earlier. On flows, hence, while the mid and the small have some tailwinds of domestic flows, larger caps have some headwinds of FPI selling. Our portfolios are growth-oriented portfolios focused on growth themes. The best exponent of these themes are more present in the mid and the small cap space. Hence, on this count, we believe our portfolios benefit from some tailwinds. Coming down to the next risk is the uncertainty around election outcomes. Well, if we look at the performance of the market 6 months before the elections, over the past 8 elections, only once were the returns negative. Similarly, over past elections, only twice were the returns negative 6 months post-elections. We believe that post-COVID, the ability of policymakers to provide protection, handholding to the industry is higher. Every country wants more manufacturing internally on supply chain issues experienced in COVID. Hence, a lot of the present day supportive policy should be expected to continue irrespective. Now, how are our portfolios positioned? The growth themes that we are focused on are all themes that benefit the nation over the medium to long term, and we believe hence should be expected to continue to see policy support. Focus on high quality of business and management further reduces associated risks. We hence believe that it continues to be time for alpha. 2 months back in August, we had shared our thoughts on various market spaces which were experiencing growth tailwinds and which are less present in large cap indices. Also, as shared above, we believe our portfolios are positioned well to navigate the risks in the environment. The earnings growth in the mid cap and small cap part of the market continues to be better than what the larger cap indices are experiencing. This has a large influence of supportive government policies and should continue to provide better growth till policy environment continues to be supportive. We believe we can sustain for a brief period a spike in crude oil prices as explained before. High forex reserves enable our policymakers to continue to focus on growth, especially since outlook on forex is good on account of lower CAD and inclusion in global bond indices. Hence we believe since growth impetus would continue, it continues to be time for alpha. Coming down to valuations. Now, valuations are at the upper end of the sustainable band. Our construct for market is 18.5 times 1 year forward earnings, which gives us a target of around 20,350 for the Nifty on 1100 Nifty earnings for financial 25. This leads us to expect a slightly lower than earnings growth returns over the next few years. However, the earnings growth over this period should be faster than long period average, as the economy bounces back and tries to recapture some of the lost ground during COVID. Mid caps are trading at a small but sustainable premium over large caps to our mind. Given the strong presence of the growth themes in the mid cap space, we do expect this space to continue to perform on a relative basis. Yes, they can correct, but next time whenever the markets create a new high, we should again expect this space to continue to perform better, especially if policy stays supportive. Overall, we believe that we run some of the fastest growth in EPS portfolios in the industry and believe that higher sustained growth in our portfolio companies should provide tailwinds for sustained performance versus the index. Presence of all growth themes and exposure across market cap spectrum provide our portfolios with a good chance of participating in the performance of any growth space as well as providing diversification benefits. Our portfolios are well diversified and have lower top 10 concentration versus the index in most cases, further providing risk control. This, we believe, improves our chances for sustained performance in the next period. Thank you. Happy investing. May the good times continue and wish you all a very happy Diwali.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.